Have you ever heard a saying, if you're paying rent, you're already paying someone's mortgage, it's just not your own? I saw a meme recently that was more or less this concept, and it got me to thinking. Find out what's going on in this brain on today's episode of Rockin Real Estate News. Welcome to Rockin Real Estate News, where we answer what's rockin' in Daytona Beach real estate. Today we're talking about the age-old debate of buying versus renting, and it's a topic that some people get pretty passionate about. I've heard the argument that if you're renting, you're throwing money away, and depending on your circumstances, that may not necessarily be true. But let's break down some of the facts behind the rent/buy debate. One of the biggest myths about renting is that you're throwing away money every month. And while some people may argue this point, it simply isn't always true. After all, you do need a place to live, and that always has a cost to it. But what is true with renting is that you aren't building equity with each payment. When you pay your rent each month, you're simply paying for the cost to live in the home you're renting. It's also true that as a renter, you may face rent increases each time your lease is up for renewal, where your mortgage payment is generally fixed for the length of the loan. Now, renting may give you some flexibility to move whenever your lease is up, but on the flip side, it also means you may have to move suddenly if your landlord decides to sell the property or just simply decides not to renew your lease. But the biggest difference between renting and owning a home, when you make a mortgage payment on your home, you're building equity, and that's simply not the case when you're writing a rent check to a landlord. What is equity? Well, simply, it's the difference between what you owe on your property and what it's worth. Let me give you a quick example. Let's say you're a first-time home buyer and you buy your home for $100,000 with 10% down. That would be $10,000. Your loan amount would be $90,000 in this case, and if your home is worth the $100,000 sales price, you now have $10,000 in equity. Fast forward a few years, you've been making your mortgage payments on time, and let's say you now owe $50,000 on your mortgage. But your home has appreciated in value, which historically real estate does, and so let's say it's now worth $150,000. You would now have $100,000 in equity in your home, $50,000 from appreciation, and another $50,000 from what you've paid in. So how do you use this equity? Well, let's say you're ready to buy your second home, something larger, a little more expensive. Now you have $100,000 in equity that you can use towards a down payment, which means you can buy a more expensive home while keeping your mortgage payments the same, if not a little lower. Another way people use the equity in their homes is when they reach retirement age by what's called a reverse mortgage. With a reverse mortgage, you stop making monthly payments and instead you receive monthly payments based on your equity. How much you can borrow depends on your age and the equity that you have. It's good to know that this is another benefit of homeownership that renters simply can't take advantage of. So back to that meme I mentioned at the beginning of the episode. If you're renting a home, you're already paying someone's mortgage. It's just not your own. Is that true? Well, that rent check you write each month certainly isn't building any equity for you, but you know who is building equity? Your landlord. If you think you might be ready to make that jump from renter to equity builder, we can help. Until next time, rock on, rock stars.